Welcome to our Construction Forum webinar this morning. My name is Christie. I'm the Chief Executive of the Sussex Chamber of Commerce. So over the last few months, every business has been facing many challenges, predominantly financial. There's been lack of income, people have been furloughing staff, trying to access grants or loans, and other support available from government. The Sussex Chamber has been working really hard in the last few months to lobby and represent businesses in government, and the effectiveness of our advocacy has led to the funding for employee retention, the extension of the furlough scheme to safeguard millions of jobs and to provide flexibility for employers, the introduction of 3-month suspension on VAT payments, income support for self-employed, startups, SMEs, high growth companies and apprenticeships, and protection for commercial tenants. And we continue to lobby to make sure that businesses have the support, the financial support that they need to succeed and for the economy to recover. I want to thank all of our members as well for the support over the last few months. We will continue to work with you. We have been helping our members also spread out payments to help ease cash flow. Recently, we had a construction steering group meeting, and several of our steering group members are on the forum today. There were some main issues that arose, and one of those was the financial stability facing the construction sector in terms of the need to consider long-term viability of future projects and tenders, reviewing your cash flow, other project commitments you may have, looking at your risk management, and making sure that you have the support from banks and other financial institutions in place in order for you to bid and tender for projects. Today, we're joined by 2 experts. We have Craig Silver, the Business Development Director at Close Brothers Property Finance, and Nicola Tilbury, Director at Potter Raper. I will also provide an update on a new financial service that the Chamber launched literally just a month ago. First, I'd like to go over to Craig. Craig has been with Close Brothers for over 20 years, specialising in residential development finance. He manages around 50 different client relationships within a portfolio of £200 million. The developments are located throughout the whole of the UK. So please, can we welcome Craig, and I will hand over to you.
Good morning all. I hope you and your families are all well. I'd like to thank Sussex Chamber of Commerce Construction Forum for inviting me to speak today. But this will be my first virtual presentation, so be patient if there's any technical issues. I hope many of you are already familiar with Close Brothers, but for those who aren't, the group is primarily focused on lending in niche markets such as invoice, asset, motor, insurance premium and property finance, with a gross loan book of about £7.5 billion. As Anna said, I've been working in the team for over 20 years, and our core business is the provision of short-term structured finance for speculative residential development throughout the UK. Our client base comprises experienced individuals and SME developers who appreciate our constant approach and quick decision making. The high level of repeat business reflects the quality of the service we provide, along with the solid reputation we have managed to establish over the last 40 years, lending throughout the economic cycles. Our loan sizes range from anywhere from £750,000 to 20 million, but our sweet spot is anywhere between £2 and £7 million. The overall property loan book extends to roughly £2.5 billion worth of commitments. Here are a few examples of schemes that we fund. Although we're primarily residential, we are happy to finance student accommodation, bespoke retirement living, and pre-let and pre-sold commercial. We don't do speculative commercial schemes, albeit if they're part of a mixed-use scheme which is predominantly residential, we're more than happy to include them. So, what a roller coaster ride the last 12 months have been. I think following 3 years of post-referendum disruption and political turmoil, property sales activity almost ground to a halt in the months preceding the election due to the uncertainty surrounding Brexit and the possibility of a radical far-left administration gaining power. Then in the aftermath of the election, there was a sense of relief that the government had achieved a working majority to remove the political stagnation. Sales activity significantly improved and developers started to take forward projects which had previously been mothballed. Going into February, everything was looking positive. But then a few weeks later, we were very abruptly back to square one. Sales activity pretty much stopped, with government and Law Society advising people not to move. Sites were closed down, and quite understandably, everyone suddenly had different priorities. When the sites did reopen, with the support of the government, build programs were significantly disrupted due to resource and supply issues, along with the need to adopt sensible social distancing practices to ensure safety of site personnel. Issues with suppliers were compounded by the temporary closure of a number of larger builders merchants, as well as suppliers from China, Spain, Italy, and other countries specialising in the manufacture of building materials. However, the construction industry, I've always found, is extremely resilient, and it's been great to witness at first hand the way in which builders and developers have adapted to these unprecedented circumstances. Post-lockdown working practices are still restricted, which will inevitably lead to cost and time overruns. But on the brighter side, the majority of our clients have seen a surge in sales activity, which I'm sure in part was simply carried forward from the transactions which were prevented from progressing prior to lockdown. Importantly, many people have had a few months in which to carefully consider both their accommodation and location. The ability to work from home without having to commit to a tedious daily commute has been an epiphany for some, including myself. Whilst others stuck in city centre flats with little, if any, amenity space will be seeking to move as quickly as possible. And this will undoubtedly favour areas like the South Coast, where demand is likely to increase in the months, years ahead. Above all, people are starting to appreciate the quality of life and access to recreational spaces more than being closer to workplaces. After all, the spectre of a further lockdown still hangs over us. This will be the fourth recession I have experienced in my working lifetime, and they've all had different characteristics, but the short, sharp shock caused by the pandemic is clearly unique. Although the GDP statistics may refer to a V-shaped recovery, I fail to see how the effects of numerous business insolvencies and the resulting high level of unemployment will not be felt for some time to come. However, government reaction to the financial crisis has been welcome, with a series of stimulus initiatives to help support individuals and businesses, including those in the construction sector. It's funny, in a recession, government always tends to look towards the housing market to try to stimulate activity. You remember Help to Buy was introduced shortly after the last recession and has been a very successful initiative, supporting almost 250,000 sales since it was introduced 7 years ago, and roughly 40% of all new home sales. It helps buyers to afford a place to live, developers to maintain supply levels, and mortgage lenders to limit the level of their exposure. The temporary stamp duty holiday introduced earlier this month should provide a further short-term boost for sales. Savills said, incredibly, just under 90% of house sales in England are below £500,000, so won't pay any stamp at all. Boris has promised to build, including significant financial support for affordable housing and a further extension of permitted development rights to create more residential space. Mortgage payment and rental holidays, ban on repossessions, measures to protect individuals and businesses from legal action as a result of debts caused by COVID-19, the job retention scheme, bounce back loans, business interruption loans have all been welcomed, although probably not by some of the landlords trying to collect their rent. Unfortunately, there's always winners and losers. However, I think these support measures really are only temporary, and unless the government decides otherwise, most will be either withdrawn or significantly changed over the course of the next 8 months. So we all know things are going to get a lot tougher as the year progresses. I'm particularly concerned by the potential double whammy at the end of March 21, when the stamp duty holiday ends and the availability of Help to Buy becomes more restricted. I'm old enough to remember the last double whammy, which preceded the 1990s recession, when interest rates doubled from 7% to 14% within a year, and the ability to claim dual mortgage interest relief was ended. The government will clearly need to carefully rethink their strategy as the effects of the recession unfold. Hopefully the autumn budget will give them more time to consider how the economy is performing, but I expect a lot more will be needed to provide a further boost, especially in the housing sector, including an extension of the stamp duty cut to sales that have exchanged contracts not just completed prior to the end of March deadline. This would promote more off-plan sales and new development, and it would also create more jobs in the construction and development industry. They could also delay the proposed restrictions to be imposed on Help to Buy, change council tax rules to ensure that a property only becomes liable to payment on first occupation, not when it reaches practical completion, scrap business rates on show homes, introduce stamp duty exemptions for last-time buyers moving into bespoke retirement living accommodation to help free up much-needed family housing, promote more green, eco-friendly, sustainable building methods, and address the supply side of housing by conducting a root and branch reform of our out-of-date planning system. I'll return to that point shortly. Now, despite the weak economic backdrop, we have continued to support our existing developer clients and some new borrowers, agreeing several deals each week, including during lockdown. In the context of house prices, I personally thought they would fall both this year and next, but post-lockdown sales have been strong, with good prices being achieved. Respected market commentators are standing by their forecasts of relatively modest drops for this year, sub 10%, followed by a price growth between 2 and 8.5% in 2021. So you have to listen. But it's hard not to think a little more negatively. Until we find a vaccine, thoughts of a deep and sustained global recession have got to remain. Unemployment will rise when the government withdraws its life support, so this will undoubtedly affect demand for housing and therefore prices. I would be delighted to see the commentators proved right. We are happy to consider funding for any type of residential project and can issue indicative terms very quickly. New applicants will need to provide satisfactory evidence of their previous development experience, as well as details of any current commitments, either work in progress or finished stock awaiting sale. We lend to individuals either in a personal capacity or more likely through their corporate vehicles, probably an SPV established for the subject project. Our loans are structured to ensure the borrower's funds are invested on day one, with the facility covering all subsequent costs to deliver the development to practical completion, including build costs, professional fees, and interest. Therefore, we would need to know how the borrower will cover their cash equity provision and whether any additional debt, such as mezzanine finance, will be required. We expect the borrower to provide a minimum cash contribution equal to at least 10% of project costs, along with a personal guarantee limited to 20% maximum loan plus cost overruns. Now, we don't need specific support for the guarantee, but we would expect to see a broad statement of assets and liabilities to evidence the borrower's ability to cover cost overruns should they be incurred. A broad financial feasibility should show a minimum return of 20% on costs, perhaps a little less for simpler refurbishment projects, but detailed cash flows would not be required for most projects, as we consider them on a fully funded basis. Our maximum exposure is based on gross development value, which usually means our contribution equates to anywhere between 70 to 85% of project costs. Our risk is twofold: delivery and sales. Delivery risk should be controlled quite comfortably with the benefit of the borrower's track record and our funding. However, sales are outside of our control, so borrowers must always ensure they adapt to market conditions and ensure that prices are not over-optimistic. Now, I just wanted to raise a few issues that affect the majority of my SME clients. The current system is heavily weighted in favour of a handful of large national house builders. The government is falling roughly 20% short of its annual house building target of 300,000 units. SME developers, I believe, are very important to the well-being of the housing economy, so they need support and encouragement as their numbers have significantly fallen since the last recession. The House Builders Federation has estimated that housing supply could increase by at least 25,000 additional units per year if the number of SME developers returned to pre-2008 levels. Government initiatives have been focused on boosting demand via Help to Buy and now stamp duty holiday, but the most difficult and important challenge to address is the supply side, and in particular, the frustration created by our planning infrastructure. I must emphasise it is the system that is failing, not the people. Over the last decade, local authorities have been starved of the cash required to support public services, and this has resulted in a highly unpredictable process, which can be very time-consuming and costly. The decision-making is too political, so it would be better if planning committees could include a mix of local industry experts, such as architects, as well as councillors. How many times do we see an application which has been recommended for approval, only to be refused at committee, and then for the decision to be overturned by the appeal inspector? At their last party conference, the government promised a planning revolution to simplify the current system. Root and branch reform is required, so let's see. The last point I wanted to raise concerns SME builders and the location of sites. They're unable to consider large out-of-town projects which require deep pockets, so they tend to concentrate on smaller urban sites, such as infills, backland developments, airspace conversions, and brownfield opportunities. But these can also be costly to design and have issues with remediation, access, rights of light, and of course, local community sensitivities. I think more could be done to help them identify and acquire such sites, as well as achieving the necessary planning approval. Councils could specifically earmark sites on local plans to help regenerate communities. And also reductions in affordable and SIL rates should also apply to smaller sites to encourage development rather than act as a barrier. So having worked in the industry for such a long time, I believe house building is a dynamic and resilient industry full of great characters with the ability to change our communities and people's lives for the better. After all, people need affordable and attractive places to live. House builders need to make profits to reinvest in their businesses, and there should be no real losers providing the system functions properly. But housing supply is too important to be used as a political football and should really be managed on a cross-party basis. I think government should establish an independent forum to support and encourage SME developers entering the industry, including cross-party ministers, larger house builders, and other industry experts. Yes, we need to do more to address the issues I've raised, and yes, the economy will suffer as a result of COVID-19, but the fundamentals of the housing market remain strong. As demand continues to outstrip supply, interest rates are unlikely to increase in the foreseeable future, and mortgage finance is available in a very competitive market. There is no silver bullet, and we all have our own challenges right now, but I sincerely think we can emerge from this crisis and make the changes necessary to breathe new life into the industry. Thank you.
Thank you so much, Craig. That's fantastic. So next I would like to introduce Nicola. Nicola has started her career as a QS, as a quantity surveyor, and highly accomplished project manager and employer's agent. She has over 30 years in the construction sector and has experience in delivering schemes across a wide variety of sectors for both public and private clients. And she also set up the Brighton office in 2017. Please welcome Nicola.
Hello, and thank you to the forum for inviting me to come and speak today. I was a little bit worried that all I was going to be able to speak to you all about was stuff that you already knew. So I'm hoping that the slides I've got will provide some food for thought, and even if it doesn't actually give you all the answers. I'm going to briefly explain who we are and then look at the current issues that we've been facing. So Potter Raper is a multidisciplinary surveying practice founded 50 years ago by Jerry Potter and Mike Raper, which is where our strange name comes from, as a QS practice in Beckenham in Kent. The practice now employs nearly 170 people and operates out of 4 offices: Beckenham, which was the original office founded 50 years ago, London office in St Martin's Lane. We've got an office in Colchester, and the most recent being Brighton, which is the one that I set up about 3 years ago. And we are just about to move into our nice shiny new offices in Hannington Lane. So thank you, Westridge. I'm looking forward to moving in there. We provide project management services, which include contract admin and employer's agent services, QSing, building surveying, and have a large team of clerk of works there too, who are seeing quite a considerable increase in their workloads at the moment post-Grenfell. Our health and safety consultants provide principal designer services, fire risk assessments, and offer strategic health and safety guidance to our clients. And we also offer bank monitoring services, and we do laser scanning in CAD, often in lots of historic buildings, to capture lots of detail in the buildings. These are just a few examples of schemes that we have on site over the past few years, and they range from healthcare, residential, commercial, education. They're refurbishments and new builds. So the one on the top left on the screen is in Hackney. It was in a conservation area. We did a facade retention there and 188 residential units behind it. We work for local authorities, pension funds, housing associations, merchant banks, including Close Brothers, where we do quite a lot of bank monitoring, private developers and landowners. So I thought I'd look at some of the existing challenges that as an industry we tend to face. And it made me laugh. A few weeks ago, I was at a Constructing Excellence round table in Surrey, Constructing Excellence Surrey round table, and we were discussing the issues that we were facing. And they could have been just pulled out of the Latham report, because they're exactly the same as they were in the mid-90s, which is sad. Productivity hasn't changed that much because we generally build the same way that we've always done. Profit margins are low for contractors. Clients tend to be driven by capital expenditure still, rather than whole life cycle costings. And this is partially linked to their viability modelling. So I think a lot needs to be done at that level to change the way clients value their buildings. What do they actually need out of them? Contractors are working to small margins. Our consultant fees are being squeezed because of the amount that we're expected to do by our clients now. And the world economics, the volatility of that has resulted in inflation rates over the past 10 years up to 15%. Our projects are getting more complex. Why put in gas boilers when you can have a centralised heating system that has more complicated controls known to man? Why have green roofs when you can have wet roofs, rain gardens? And the need for reducing our carbon footprint is just driving the amount of technology being installed into buildings now, and different types of construction that are being explored, and the use of modular. So there's more and more technology going into our buildings that we need to understand. clients are still keen to transfer risk to the contractor rather than dealing with some of these risks themselves, not really interested in who's best placed to manage those risks, and seemingly happy to pay for it. As a consultancy, we will sit with our clients and highlight some of these risks, and some of them are just quite plainly happy to pay somebody else to take the problem off their hands. Some clients, though, are going to tender for a D&B with stage 4 drawings and stage 4 design, which makes no sense, but still they are happy to carry on in that way just because of their risk profiling. And then at the other end of the scale, we have some of our housing association clients now who are looking to go construction management and start doing that themselves. For some, that works well. For some who have this idea that they can do it and really don't know what they're doing, turns into an unmitigated disaster for them. The supply of contractors, and more importantly subcontractors, as Craig said, has been decreasing over the years, partly due to lack of skilled operatives, and then partly due to contractors folding due to low profit margins, poor cash flow and late payment. And only one scheme needs to go wrong to take a company down. And this is just getting worse as we're coming out of COVID. I think the key thing is to not panic. We are seeing, on top of Brexit and then COVID, you've got into that mix, you've got the consequences of the Grenfell fire disaster and the push for build off-site and modular construction. So it's not hard to see why we're all running around in circles trying to get our head around what we could be going into now as the new normal. And the challenges that come with that is the amount of work that COVID is causing us now at the moment. There's a lot more work now on top of our day job. We were busy before. Work was getting really busy. There's lots of projects out there, but now we've got, instead of a few jobs with an extension of time issue or loss and expense, they've all got that issue. So we've got an awful lot of work to do there. We're looking at how we calculate COVID costs. Some of our public sector clients are much better at being open to share some of the COVID risk costs, but we need to monitor what costs are we going to pay towards, and how they're being recorded month on month, and how long is this going to go on for. And this is causing a lot of work. There's also the implementation of the procurement policy notes with public sector clients who are looking at advance payments and keeping that cash flow moving for contractors. Now that brings a lot of risk with it for main contractors and for clients, because if you're paying upfront for some of this work and the subcontractor goes bust, then who's losing out? It tends to be the main contractor. So we're trying to stay away from that if we can at all avoid it. And COVID's brought the sudden need to improve our IT systems and ability to work remotely from the office. And for some people, that's meant more cash investment in their IT infrastructure at a time when you really can't afford it. But at the same time, you can't afford not to do it. You've got to keep up with what's going on and allow your staff to work from home. But then coming back to the office or coming back to site's been a big headache for everybody as well. And for some people, it's been too difficult, so they're going to remain shut for the foreseeable future. Many offices who have reduced their sizes and the hot desking now are finding it practically impossible to come back to the office. So, as Craig says, some people might like that, but some people are finding that really hard. And even in our own company, we're working really hard on mental health and well-being, just to keep staff connected. When you're suddenly working remotely, that's very hard to do. And then managing your junior staff. How is this affecting apprenticeships, work placements? So I know of some people where they're meant to be starting an apprenticeship in September, and that's now been put on hold or just rescinded. Getting our head around the fire regulation changes and what that means to our schemes has caused us an awful lot more work as well. Either existing buildings where we've already built and the mortgage companies are insisting on the buildings meeting current requirements, which simply isn't possible. So therefore people can't get mortgages or remortgages on them. Schemes where we've just completed and the paperwork we're needing to do, Regulation 38 reports, independent certifiers, and those that are still on the drawing board. And the changes that we've having to go through for that, redesign. So clients are spending more money on schemes that were designed in one way and now need to meet new regulations. And then one of the main difficulties, especially for consultants anyway, is the Hackett report and the issues that that's caused with professional indemnity insurance market. Premiums are rising and rising, and some firms are struggling to get cover. The number of insurers in the market are falling away, and those that are left are imposing really quite severe restrictions on the level of risks that they will cover, and some now starting to include anything related to do with fire. And we're all starting to look at the golden thread and how we manage that digital journey of records connected with fire safety of buildings and approved document B changes that come into force in November, and the looming prospect of the building safety regulator and the confusion that that may bring, along with every change that tends to happen with safety in the industry when we went from planning supervisor to CDM coordinator to principal designer. Nobody really sure what's happening and who should be doing what. And then Brexit causing concerns on materials and labour shortages, cost increases. And the cash flow impact of COVID is causing stress on the industry, with many of us having to implement temporary pay cuts to staff, looking at increasing the number of valuations that are being done to keep things going. And then for me, certainly, there's the never-ending Teams meetings that seem to be happening now. And it's a phenomenon that reminds me of the introduction of emails. I can remember back then where emails were going to be the answer to our efficiency and productivity. But actually, we ended up being swamped and smothered by emails, and people's expectations of being able to turn around and answer that email within 5 minutes of receiving it, and then getting another email. Did you receive my email yesterday? That's kind of happening now, because instead of just sending an email, clients are asking us, oh, can we have a quick team meeting? There is no such thing as a quick team meeting. We're also all guilty of, oh, I finished a team meeting at 11. I can have another one at 11. I'll squeeze that in. No, you can't. You need to breathe. You need to think. Last week, I think I had 2 days where I had nearly 10 meetings over 2 days. That would have been impossible in the pre-virtual world. I think I'd quite like to go back, to be honest. Looking at what's actually happening out there, as Craig says, we're experiencing quite a lot of work still going on. Public sector clients are still wanting to build and develop. A lot of them are seeing it as their responsibility to keep the construction market going. My concern with that is some of the news recently of some public sector clients looking at potentially becoming bankrupt and asking for loans from central government. So again, there might be a push as we move forward and a squeeze on their amount of funding that they can do. The housing market is definitely buoyant. Public sector housing, they're delivering affordable housing. Housing associations are still delivering. They're probably delivering slightly more affordable now, given the market sector pressures on private sales. Private sector are cautiously starting again, following the Brexit slump. As Craig said, they are still developing. Some of our big pension funds are starting to develop now. Obviously not as much in commercial areas and mainly in residential. There's differences starting to emerge between cities and regions. I've been to a couple of events recently on London and looking at how they're trying to get their head around COVID and the impact that's having on central London development. But I think for Sussex and coming out of London, there's going to be quite some positives coming from this, and we need to seize these opportunities and looking at polycentric centres and cities, and then looking at hubs on the outside. So for those people who don't want to commute into London, but also don't want to work at home, there's going to be more and more, I think, out of city office developments where people can work, potentially like Regis serviced offices type things, where you can still go to the office and work with colleagues, but just not travel into London. So there's potential there, and that'll also bring with it the potential of more housing, which is going to be a good thing. From our experience, a lot of the contractors that we work with are really busy pricing work. But the risk to me is if that work will actually be built out. I think some of these things, some of the projects that we're looking at now, the wheels are in motion, we're going through that, but will they actually be built? I think especially with the non-residential, and I can see those being priced and parked. But I think they will come back, but we've got to get over that gap with our cash flows. One of my concerns as well is that we're seeing definitely where we're tendering is contractors pricing low to secure turnover. And I think everybody has to really resist that if at all possible, because it's not very productive for the industry. We're losing out, I think, to some of our competitors from low pricing. But again, that's what's got us into a lot of the mess that we've had before with the building safety and fire in the first place. Existing contracts that we've got at the moment, most of our clients are agreeing to time and no cost in relation to COVID clauses and COVID expenditure, mainly driven by the fact that most things are under JCT forms of contract. I think those which are working under an NEC or a PPC form of contract, as soon as there's an extension of time, there's an entitlement to cost. So those conversations are happening. Some of our housing sector clients are definitely looking to contribute to the COVID costs, because again, if contractors are having to swallow all of that, it's impacting on their cash flow. Open book accounting for any clauses that are in there is causing an awful lot more work for both parties, both contractors and the consultants moving forward. As Craig went through, the build programme of relaxation of planning rules is an exciting one. I think that SMEs could definitely exploit. What would help potentially is the relaxation of VAT on some of this refurbishment work. The retrofitting of sustainability as well is another area where I think there's opportunities. The furlough schemes and retention initiatives for staff and skilled staff have got to be exploited. And again, as Craig said about the infrastructure and affordable housing funding. An interesting document, and I don't know if anybody's seen it, is the Construction Leadership Council's Roadmap to Recovery, which has got 3 phases. And I think the restart has definitely happened. The increases, we are seeing an output increase now. We are starting work again, we're extending working site hours, which is helping, but we need to carry on with the resetting and how we carry on driving that demand and increasing productivity and making sure the supply chain is ready for that. And to reinvent the sector, we need to be looking at value and collaboration and probably digital technologies and increasing the use of technology and how we do it. To do all of these things though, we need to be in a really good financial health to be able to cope with that. Now, moving forward and our thoughts on this, what is the new normal going to be like? And I think, yeah, like I say, digital technology to improve performance, potentially reducing unnecessary trips to site. For most people, efficiency definitely for lots of people has improved since we've had some home working. The golden thread and the need for that to be digital has got to be explored, and I know contractors are starting to look at how they're going to implement that. Potential technology such as cameras on hard hats so that you can see site without having to go to site and keep social distancing within COVID, because it's going to be here for some time, we all know that. So we need to be able to work in this new normal way of working. And I think clients have got to be really clear about their pipeline to allow the sector to respond effectively so that we can put those resources into carrying out the estimating that's needed for the consultants to be able to physically allow enough time for all of the projects that they're working on. And we have got to embrace the world of virtual meetings, however much we like it or hate it, it's here to stay. And I think things like this, I think it's really good. Doing seminars and webinars remotely is great, and it does allow design teams to push things and keep things flowing much quicker than we ever used to. But then there's that expectation, just like the emails, that things can move faster and faster, and then that has an impact on the fees that everybody charges and the rates at which we can work. I think it's key to remember it is not a race to the bottom. We've all got to stay quite firm on that, and that to get our financial stability, we need to not undersell ourselves, because we'll just see more and more people going out of business. Collaboration and communication is a way to effectively rebuild the sector and keep us moving forward. We need to embrace new methods of working, including offsite and modular, and look at how that can be efficiently incorporated into the procurement of those particular skill sets. And like I say, the reduction of VAT on retrofit and refurbishment, that's got to allow a lot more work to start taking place, especially around the relaxation of the permitted developments that the government have brought in. And I think flexibility and adaptability, having a cross-sector of what you can work on, not just being linked to just housing or residential or commercial sectors, but being able to do a bit of everything is going to be really important, so you're not over exposed to one particular sector. Because the leisure centre will start coming back. We've got schemes at the moment which might have had a leisure centre on part of it. That bit's been put on hold because of the situation, but that is going to start coming back because people are valuing different things now, and so the leisure centre, I think, is going to be one that's going to come back with some force. And I think that's probably it. Thank you.
Thank you so much, Nicola. Thank you for sharing those thoughts. What I will do now is see if I can share my screen. Good. Okay, so about a month ago, the Chamber Network met up with a company called Swoop Finance. And so we introduced a new Chamber Finance Finder for our members. Now, this was because businesses were really struggling to understand all the different financial aspects out there, whether there was loans and grants. So we launched this, and it's powered by Swoop, and it's introduced by the British Chambers of Commerce. So members can access this tool. It's a portal that you can access. It's a free of charge account that you set up. There is no charges whatsoever for accessing this tool for our members. And it really lets you know what you're eligible for, whether there's loans or whether there's grants or even like equity funding. So you have the support of the Swoop Finance team. They're available 7 days a week. They actually conduct a financial health check of your business. They can provide you with templates and tools to help you in your application. And it also gives you updates on what finance is available nationally, as well as alert you to whether new grants have just come out through government. And there's also a finance newsroom as well. So I'm not sure if you can see that, it's quite small. But basically you just have to register for an account. It just asks you a few simple questions. You then start to build your profile on the portal, and it integrates with Companies House. So it uses cloud accounting and online banking as well. It accesses, so it gives you like an online dashboard. So it links in with Companies House and it links in with your financial accounting systems. Then what it does, it starts to match you to different funding options and opportunities. So it uses the technology, it tells you what products and services are available and most relevant, whether it's loans, equity or grants. And then you can submit your application through this process. So it's really simple, it's really, really fast to access. It tells you what you're eligible for. You do have the team of experts that can also let you know, if you get stuck, if you have any questions, they're available there to help you. And also you can track your progress through the portal and receive notifications. So as I said, it's a free financial health check. You've got loads of templates and tools to help your application, and it gives you finance updates and news. So this is a little bit small, but I will share this with everyone. So basically it has the technology links into all of the providers. They are regulated by the FCA. They links into all of the loans, whether it's asset finance, invoice finance, trade finance, business loans, working capital, merchant cash finance. Also different grants that are available, whether that's R&D, tax credits and Innovate UK. Also links into different finance options such as the C-bills loans and bounce back loan schemes and future fund schemes. And also equity such as high net worth, angel, venture capital, family offices and crowdfunding. So there's lots of questions that sometimes people ask on this new business funding platform, but it's really quick and easy. It gives you immediate access. It does link in with 1,000 different funding providers to give you all the suitable matches. You can set up your free account. The platform automatically pulls your business information, as I mentioned, from Companies House and pre-populates the platform already for you. And it integrates your bank account via an open banking API. So it reviews all of your information, your turnover, your debt service recovery ratio, and it educates you on key stats as well and figures that funders are going to base their decision on. People ask about the security and the privacy of the scheme. It is subject to data protection or GDPR rules. It's financed or powered by Swoop Finance Limited, and they are regulated by the FCA. And they do, obviously, they've been mandated by the Competitions and Market Authority to work with major banks and all of the financial lenders in the UK. So all of them you'll be able to see all of the different finance options available on the market. And then it just talks through if you've got complaints and how does the Chamber Finance Finder make its money? Well, it doesn't. It's free for customers, and basically Swoop Finance are the ones that get paid a commission based on the standard terms of the financial lender. So they have their own agreement, but there is no charge whatsoever to any Chamber members. We don't charge anything as well as the Chamber. And there's questions sometimes about what if your bank account's not integrating with the system, and how you receive email notifications and everything, and if you want to delete your account. So there is lots of Q&A that will help you answer this, but there is a team of experts in the background. Basically, it just lets you know what funding you're eligible for, and then whether you want to take that application further, whether it's through a financial lender or through a bank, what you need to do. It tells you the rates, the loan period, what you'll need to pay, your commitments and everything. So it's all detailed out for you before you make that commitment. So you're not actually, it doesn't affect your credit score or anything like that until the very end, until you start to actually agree to, yes, you want to go down one route and access funding from a particular bank, for example. So you can go directly, but that means going directly to lots of different providers, whether you're applying to a bank for a loan or whether you're applying to the council for a grant or something. This tool actually puts all of the providers in one place and lets you know, based on your financial circumstances and your bank accounts and all of your financial history, what you would be eligible for, whether it's equity, angel funding, whether it's a grant or loan or whatever that may be. So it gives you all the different options available rather than going to all of the different providers individually. So lots of Q&A there. I will stop sharing my screen. I know that was just a whistle-stop tour, but that was just a new tool that we actually introduced literally just a month ago to help businesses try and navigate through the funding landscape. So it's a really new tool for the Chamber network nationally. What I would like to do now is open up to Q&A. One of the things that I put on here is, because I think it was Nicola that mentioned apprenticeships, was that we need to encourage businesses to really look at apprenticeships and helping support young people, but also supporting those that over the next few months we're going to see a lot of redundancies. There are going to be a lot of sectors, a lot of businesses that will be making redundancies. So it's looking at how can we support apprenticeships, young people that will have not had that opportunity to really apply for jobs over the last few months after they left college or finished their university. And we've seen a drop in apprenticeships by 85% nationally. So we really need to look at what can we do to support young people to get them back into the workplace. Equally, we're going to see a change in terms of the coming out of the EU. in terms of the new immigration points-based system and how you have to then sponsor, you have to go through that process of appointing somebody to work in the UK. So there's going to be added costs as well. We're going to have a huge unemployment workforce that we can reskill and we can help to upskill as well, or get into the construction industry. So I just wanted to maybe put that out there. What we really do need to support getting people into the workplace. And it's really sad when I see that there has been a decline of 85% nationally in apprenticeships. We really need to do a lot more to get people into the construction sector specifically.
If I can just say something, Anna, I think the over the years the skills shortage has grown and grown. Like you say, generations of bricklayers or stonemasons, etc., haven't passed on to the younger generation, and the Brexit situation with potentially putting a block on Polish labour, Eastern European labour, which has helped support the construction industry for many years, is going to be potentially a big issue moving forward, especially with Brexit. So it does need to be encouraged, but I'm kind of adrift from the actual construction industry on my side to be able to help that. But anything that can be done, I think, should be done.
Definitely. There was also some points that I put there, and it was really referring to some of the comments that were made by both yourselves, Craig and Nicola, in terms of, I think businesses will adapt as well over the coming months. More will work from home. We'll see a shift in potentially hubs or businesses moving out of London or setting up offices, people working from home, a change in not having such large offices for business and maybe using more hot desking or shared office space and allowing some staff to work from home. So I think you referred to that already, Nicola, haven't you? You've seen that shift already.
Yeah, definitely. We're working in the bubble. I think Phil had said in the chat that different ways of working now, and we're definitely, having moved offices in the middle of all of this, it was very apparent to us that we still wanted to have that office space, and working remotely definitely had a disconnect between all of us. So it's nice to come together sometimes, but definitely in the whole bubble situation now, we're having half of us coming in for some of the week and the other half coming in the other times of the week, and that's working well at the moment. So you've still got that connectivity, but then you still have the benefits from working from home. I mean, most of our staff can walk to work. I have an hour's drive, so for me it's perfect, and I use that time to exercise, so it works well for me.
Brilliant.
But I couldn't work from home all the time.
No, I think there's that need for social interaction, social engagement, and we've seen a huge increase, lots of feedback we've received in terms of mental health issues and people just needing to really have that face-to-face interaction rather than being zoomed out all the time.
Yes,
absolutely. I mean, our main office is in London, in the city. I haven't been back there since mid-March now, and I think that the face-to-face contact in our industry is important, not only on an internal level but externally. I've been out to site, meet clients at sites, and it's been very beneficial, and they've welcomed it. I think we were quite fortunate insofar as our office in London was just undergoing a complete facelift, a refurbishment, and the contractor, I think, was extremely happy when lockdown happened because the building emptied and they had a free run of it, and it's going to be finished in September instead of December. So it's had its benefits in that respect, but they are already thinking of how the internal desk arrangements should be, and as Phil said there, hot desking could be an option, but I would hope that even in this new normal that we can get back to some element of where we were before, and I think we've just got to learn to live with it and allow the economy to get back on its feet. and just be sensible and protect the vulnerable people, and that includes working in the office environment. In our business, I think it's important. Smaller businesses may be able to get away with working from home and changing their perceptions on how things move forward. But I think big organisations still need certainly to have a good level of face-to-face contact.
I have a question here. Where was it? So that there's already, I believe it was Doug that mentioned this, that we've experienced some unsustainable bidding levels and heard of other occurrences. So it's a question to both of you. What advice do you give to clients upon receipt of super low tender bids for projects, and how do you steer them away from accepting tender sums that will only lead to pain for client, professional team and the supply chain?
That is really difficult, because some clients will just say to us as a consultant team, well, that's your job, not my problem. And even if I spend a load more money on variations, it's still cheaper than the next bid. And so that's not unhelpful, obviously, not a helpful response. We do work with them to try and say you do get what you pay for. So if you want the level of responsiveness from a contractor, then you do have to pay sensible sums of money. We do review, and we have knocked out abnormally low tenders, but you're reliant then on you having one person sticking out the bottom. If a number of the tenderers are doing the same thing, then it doesn't stand out as abnormally low, and a client will just say that we've overpriced it. So it's a really difficult one and not a straightforward answer, I'm afraid. Other than we just highlight the slippery slope that a client will go down if they follow that route. We can't always stop them.
I would just say, from a lender's point of view, that we lend to a mix of builder developers, i.e. people who just run projects on their own on a construction management basis, or developers who employ third-party contractors. And it's the latter, which is the one that we tend to be a little bit more cautious about. We like to know who the contractor is going to be, what their track record is, and the sensibility of the pricing and the contract terms is then passed over to people like Nicola and her team as a monitoring surveyor to be able to tell us whether it is sensible, whether it's included, or it's tight enough and there's not too many provisional sums involved, etc. Because the more wriggle room there is, obviously it might be cheap at the outset, but it'll come back and bite you at the end when variations come through.
Yeah, we've done that. When we have done that, when we've been working for bank monitors on bank monitoring, and we've had 100% loan requirement from a developer, and we just say you cannot build it that cheaply. I don't know how they're doing that. So if that developer goes bust, there's no way the bank could come in and still make any money, because they would lose money if we had to go and get another contractor to finish off the work. And so in that instance, when we've done that recently, the fund has withdrawn their money.
I think, Doug, you had another question as well, so I'll just follow that up before I come to Nigel with your raised hand. Doug, you asked a question as well about how can we work together in the region to ignore suicidal bidding so that it ends up going away, and should there be some form of voluntary code of conduct in order to protect the supply chain?
I know I have an answer, and Doug and I have already discussed this. But I do think that clients who have their own framework of contractors, and we're working with a client at the moment to try and establish a framework, but the framework shouldn't be on mini competition. If you've got that framework, especially in the Sussex area, where you've got some very good, reliable contractors, provide yourself with a relatively small framework and then just rotate the work throughout. Negotiate with that one person, so that you're not creating this kind of maelstrom of ridiculously low pricing, but you're paying what you should be paying for a job. And with the guarantee of throughput and pipeline, then you'll get more collaboration with the contractors, so that they will be pricing realistically, and you can work on that as you move forward. Is one of my solutions, which we're trying to work on. And Ben's got a good point in the chat as well. Negotiated and two-stage tendering, I think contractors should be trying to look at the moment. And clients as well should know that they're going to get a better result at the end of it.
Thank
So
you.
it comes down to demand and supply, I suppose. If the client is looking for the rock bottom price and will go and will just head for that, whatever the consequences, then you're always going to get people who are going to bid at lower prices in the knowledge they're undercutting to try and win without actually having the fundamentals covered off. So it's it is very much on the client's responsibility as well.
I think most of this stems from client education and client understanding, but they will generally always be, as Steve's just pointed out in the chat, we've been talking about this since year dot to try and get people to change their mind. Latham was trying to do that in the mid-90s. Mosey's been trying to do that recently as well. PPC's been introduced to try and address some of these things, but the take-up is really low. So I don't know how, it's a difficult one to try and change the client. It's the client side it's got to come from.
We're actually working from the other side of it as well. So, for example, where we've had situations of, we've known there's some suicidal bidding going on with certain contractors, when we're looking at our supply chain for our current and jobs in the pipeline, we're actually identifying if they're working or proposing to work for those other contractors. And if they're not, we're generally putting them to the back of the queue, because it's a supply chain that's going to fall over. We don't want them falling over on our jobs. So we're kind of doing that in the background, which is a way of sort of educating the supply chain that they need to be a little bit more wary about how they're working and who they're working for. But yeah, I totally agree. It's got to come from the client side. But I think everybody's got a bit of a duty towards it.
Yeah. Yeah, I saw in the press that Bellways were asking their supply chains to reduce their rates by 5%.
Yeah.
It's a bit like Tesco's.
Yeah, exactly. Tesco's and their tomato supply.
Yeah.
Thank you. Can I come to Nigel? You've got your hand raised, so I believe there was a question that you wanted to ask.
Yeah, I'm just interested in Nicola's view on the marketplace and how she sees JCT contracts dealing with COVID risk moving forwards, both in time and cost.
Right, I say we've got a few of these now. At the moment, we've got some schemes that have literally been tendered over the COVID period, and we've introduced some COVID terms, or we've done a risk allocation where contractors taken on risk on the known COVID activities at the moment has extended their programme, and we've agreed additional monies for a fixed cost risk. We're putting in lots of COVID clauses. Some of our clients and some of their solicitors have changed force majeure amendments in the contracts as well. But a lot of the COVID clauses and COVID relief events have been defined and are being looked at on an open book basis as we move forward. So there's an agreed split between client and contractor, which is a really positive attitude. Most of our clients haven't been adversarial about it at all and want to help as much as possible. And lots are making voluntary contributions to the costs that we're experiencing at the moment. The issue we've got now, of course, is going into contract where we know we've got COVID. So prelims rates are increasing. So we're seeing that already. Contract programs are obviously increasing. But it's a bit of a moving feast, as I said in my slide, because you don't really know if we're going to need that period of time, because it all might go back together, back where it was, or we might end up with a second spike and we all shut down again. So those defined terms are really looked at on a case-by-case basis, but they are being drawn up now by the solicitors.
We do have a webinar coming up, if it's of interest, Nigel. It's on the 27th of August, which will look at terms and conditions of contracts, because this is an issue that's been coming up with a lot of different sectors in terms of force majeure being applied and when it can and can't be applied. So that may be a webinar that you wish to join. We have a lawyer speaking at that event.
Okay, thank you.
Yeah, that's really important, because the force majeure and the government intervention after base date discussions that we've been having to date fall away in the current market. Because force majeure, we know of the event, it was in the contemplation of the parties when entering into contract, so you can't really use that as a COVID related event, and you can't use the intervention by government after the base date because they've already done it. So unless anything new happens, there isn't any mechanism to to get that extra time or loss and expense. So which is why I think we're seeing now these COVID events as a specific defined term being put into contracts just to cover this, because it is so difficult to try and, you can't crystal ball gaze. It's so difficult to do, but it has to be.
Thank you. I'm just going through the chat. So can see in the chat from Philip here about the patterns of daily use in the offices and other building types in terms of retail, education, and that there is a shift as well in working. Is there anything else that you wanted to add at all to that, Philip? I don't know if you want to come on and add to that.
Hi. Not really, actually, Anna. I was going to suggest that I know that we're organising another seminar in the not too distant future, which touches on these issues.
Yes. Yeah.
So
yeah.
So it might be a good moment to promote that.
Brilliant. Thank you. Yes. So we are the Sussex Chamber, along with the Construction Steering Group. We're setting up another forum, and it will be looking at the changes in office space, the demand, looking at how it's all modelled, hot desking, multi-use type space as well. So please keep an eye on our website for that forum. We will be having some more coming up every single month.
One of the issues on that multi-use and the lovely virtual meeting is having gone back to the office and having multiple virtual meetings in the same open plan space is complete chaos. So people either need to invest in headsets, or what we're looking at is creating Zoom booths, as we're calling them. So just like going to a library where you've got some kind of acoustic paneling around you, because the mics just pick up everything around the room. So it's very, very difficult to have more than one. And with social distancing and joint meetings, we've discovered that you can't have more people in a Zoom meeting in the same space because you get reverberation and feedback.
Yeah.
So that's quite difficult.
Yeah, it is. Lots of chat about changes in office space as well. So that, please do look out for that forum that's coming up. Should be in the next month or two. Psychological impacts as well from Janet here, particularly for extroverts being apart from colleagues. Yeah, we've seen a lot of psychological mental health issues from people that just need to get back into that office environment, need to have that social interaction. It's impacted everybody in so many different ways. So I didn't know if you wanted to add anything further, Janet, at all, or...
It's something that employers need to think about, really, whatever your business is. And it's not just being apart from people. There are also people who working from home has risks involved, or, you know, not everyone has a nice study that they can work from. If you're trying to balance a laptop on your knee on the sofa, it's not great. It's not a great working environment. And employers need to think about that, and I guess the construction industry need to think about how we don't lose office space. That's all.
No, definitely true. I mean, when we went into lockdown, you know, some of us will have had, I had my husband at home and my 18-year-old as well, finishing his last year of his A-levels. So it was all like trying to find space within the house where you could have that conversation with everything going on around you. So it has been very, very challenging. So I do go back into the office every so often. I was back there yesterday. I'll be back there tomorrow. So it's nice just to get out sometimes and go back to the office. Definitely. There's also been, yeah, I think Nicola's already picked this up in terms of negotiating on two-stage tendering could be considered. That'd be a nice way to pick the contractor closer to the median value, the same way as consulting fees. Are there any other raised hands or questions? I'm just slowly going through the chat to see if there's anything else.
I'm just going to go back to, somebody mentioned golden thread and asked what it was.
Yeah, yeah.
You've answered that. The golden thread came out of the Hackett report and is part of the new fire regulations that are being brought through, and it's emphasising the checks that need to be done specifically on fire and combustibility of materials right from the beginning. And so the building safety regulator's got 3 different gateways as we move forward. So pre-planning, we've got to have obviously fire statements, and that now needs to be recorded digitally. That then needs to be progressed through to gateway 2, where you've got before construction, you've got to show that the design is safe. But again, it's just all of this has got to be digital to be able to be passed on to the people who are running the building afterwards, so they can show and demonstrate that these have been checked at every stage of the process. And then there's another one again, before occupation, where you've got the FRAs, the pre-occupation FRAs, and more detail on that fire, all that fire stuff really. So that's where it's come from, is from a fire regulator point of view.
I think there was also a comment here by from Simon in terms of 2-stage tendering does provide a situation where the client designs team and the construction team can collaborate to a much greater extent. And I think there's got to be a lot more collaboration and partnership working as well. So bringing the teams together earlier, this does need to be a consultant-led lead to encourage the clients to go down this route. So people still finding challenges with regards to this? Are there still challenges in terms of this?
A lot of our clients quite embrace 2-stage tendering sometimes. Sometimes it's right, sometimes it's very much the right thing to do. Other times there's the risk of cost escalation for our clients. So we don't always recommend it, but it depends on the type of build.
Okay, I can see Judy has her hand raised. Can I ask you to come in, Judy?
Yes, good morning. I'm a bit of an outsider to this really, because my background a long time ago now was in construction, but I'm now Deputy Leader of Mid-Sussex District Council. So part of my, my portfolio is the Estates Department. So we do small amounts of building works for frameworks, but also the Burgess Hill Growth Area, which is a huge scheme mainly funded by Homes England. So I'm interested from the Labour point of view, and hearing about, which I already knew about, but about the shortages of skilled labour. But as a council, though we're a small shire council, we, as Craig mentioned earlier, are very keen to get the local economy moving. And I've noted the comments about scrapping the business rates on show homes and council tax payment deferrals until first occupation. And I just wonder whether there's anything else that you think that local councils can do, bearing in mind that our hands are tied by government rules. But you know, if you've got any ideas, and I'd be very happy to take them back and talk to people, bearing in mind our MP is DWP Minister. You know, we would like to help the construction industry.
So does anybody have any questions they would like to raise and for Judy to take back? Craig?
Well, my comments really were based on trying to support and encourage what is my client base, which is focused on the SME builders. And I think it would be helpful if there was more of a distinguishment between large and smaller sites. I think that's the point I was trying to put across, because the smaller sites are as important to encourage as the larger out-of-town projects. And I just think that if there was some sort of differentiation that could be made to encourage those developments, I think it would help the numbers of SME builder developers that are out there, because they have, as I said, dwindled since the last recession. But it's very much a question of collaboration, I think, between the councils and the developers, and without having too much friction or contention during the process. And that was one of the main bone of contentions from my client base is just that element of the planning process and the frustration it causes.
I think also there's a need to encourage the local supply chain. So to look at local suppliers, look at local contractors and builders. So that's what I see, that's what's coming through as well. And I know that there's also, I've been involved in terms of the Get Britain building, and I sit on the South East LEP board, but I know that there was also all of the LEPs, all the local enterprise partnerships were asked to put in funding for projects that are shovel ready and that can be completed in the next 18 months. So hopefully we should get the feedback in the next week or so, or 2 weeks, in terms of what projects have been given the funding to carry on and deliver. So there will be a lot of projects that will help with infrastructure or schools or high streets, or to really, so there'll be a lot of projects, but it's making sure that we are using that local supply chain as well. So when it comes to projects that have been approved by Coast Capital LEP or through South East LEP for East Sussex or Kent and Essex, it's making sure that we are also involving the local supply chain to really help boost the economy.
Yeah, one of the things that we are doing, which talking about the LEP, we've just put in a shovel-ready bid for full fibre and gigabyte technology and technical things that actually I don't understand, but I'd quite happily send you some information about. Because everyone is having to work at home. Interestingly enough, in the last few days, it's been in people I've been talking to in towns like Haywards Heath and East Grinstead, where they've had a lousy broadband connection, and I'm out in the middle of the countryside and I'm fine. It's very strange. Probably too many people, but in our new way of living, we have got to have the right infrastructure. We've got to have the ability to be able to have these meetings without interruption. Teams fails abysmally because of the broadband width. So we have got the funding in place for a certain amount of full fibre, but we're getting putting in bids for more funding, and I'd be quite happy to send. I mean, you probably have that information anyway, but send it to anyone who wants it.
Please do send it to me, Judy, and I'll be happy to share that with everybody as well.
Yeah, I'll do that.
I know that also we had an update from Gatwick Airport, and during the lockdown, the Gatwick Airport station development has been able to progress a little bit quicker than expected as well. So that's progressing well. But with this funding that will be coming through for the next 18 months, this will really help develop projects in terms of the infrastructure and projects that really were put on hold and need that extra support just to get them finished. They're already projects that had planning permission. So hopefully we'll get to hear which projects there are, and we will share this information as well to everybody. Are there any other questions or chat? I did just add, so I know there's been a lot about digital and there's been a lot about mental health, that the Chamber has literally just launched, or is about to launch, it's this week, 4 free training courses. They're certificate level 2 training courses, and they're fully funded by East Sussex College Group. And so please do have a look at our website training. They're digital skills for work, mental health first aid, quality and diversity, and lean organisational management. So they are fully free, and even those that are on furlough can undertake these training courses as well. So please do have a look at these. Have you got any other questions at all for Craig or Nicola? Can't see any other raised hands. I just wanted to also point out another webinar that we have coming up that may be of interest. A lot of the construction sector, a lot of the supplies do come from Europe, from overseas, and these rules will change from the 1st of January. We have an event, a webinar on the 18th of August, which will look at the new changes that will be implemented, because there will be new customs declarations and VAT and import duties that people will need to complete. The Chamber network will be providing this process in terms of customs declarations. We already provide an export documentation service, but you need to be aware that there will be added costs in terms of any supplies that come in from Europe. And so that could be passed down the supply chain. So this event that's happening on the 18th of August is a free of charge event. It's with the British Chambers, and we have an expert speaker there talking about the changes that will be happening. It will also touch on the immigration points-based system, because again, there will be implications and costs, and we're asking government to make sure that applications are processed smoothly, that there's processes in place to help people become sponsors, to sponsor somebody coming over. So this will all impact your sector as well. I did mention earlier that we are likely to see a lot of redundancies, because as the furlough scheme ends, businesses are still having to recover and trying to find that the cash flow that they've lost, all the finances that they've lost. So unfortunately, we will see redundancies. We have already seen this. So it's looking at how can we upskill or reskill people and put them into different sectors. So whether they've got customer service skills because they've worked in certain airlines, for example, there's opportunities for them to come over and work in the construction sector as well. So it's looking how we can reskill and upskill people to help provide that employment to boost the economy locally. So please do keep an eye on our website for more webinars that are coming up, the training courses. So I'd just like to take this opportunity to thank our speakers again, to thank Craig and Nicola for your time this morning, for sharing those invaluable insights. Thank you so much for joining us today on our construction forum.